Hey, what's going on, everybody? Welcome back to Bonafide Investing, where we talk all things high yield investing, as well as futures, options, and investment goals in general. If you're new to the channel, welcome. To give you a little bit of background about what we're doing here, I've been experimenting with about a quarter of my net worth just around high yield strategies. And I've built what I call a high yield all weather portfolio that I've named Cash Flow Life here, that seeks to, number one, pay all my bills, and number two, maintain and pay down my margin over time. Please hit like and subscribe if you like what we're doing here. Please help support the channel. Everything that we discuss here is not investment advice, not now, not ever. So please do your own research and due diligence before making any investment decisions. What I want to talk about today, I wanted to do kind of a compare contrast across two different ETFs that I'm a big fan of. I currently don't own them, and I've considered getting back into them. One is Defiance's SPYT, SPYT. This is their target income of 20% annualized, right? So they pay monthly, and they target to produce 20% for this ETF. The other one outside of SPYT, for some reason it's not cooperating, is XPAY. We'll look at Roundhill's XPAY. And this is the other one that I want to kind of compare contrast today, is XPAY. Same goal, target 20% annualized for this ETF as well. Now, I've owned both, and I want to kind of talk a little bit about both of these and let you kind of know which one I would prefer to buy if I had to buy one right now. So why don't we start with talking a little bit about XPAY here, okay? I don't look at total return on Robinhood. I think it's so pointless. They don't ever account for distributions from these ETFs and closed-end funds. So I'm not going to look at any sort of performance data, at least not here, because like I said, Robinhood does not account for distributions. So if we talk about XPAY to kind of kick things off, it aims to provide, again, like I said, 20% annualized rate. The upside potential, though, on XPAY is uncapped, okay? So they will, it does provide exposure to the full S&P 500 return potential, which is great, okay? The distributions that it gives out, it uses return of capital, which is my preferred, my favorite. So that's tax deferred income until the fund is sold. Okay. It just brings down your cost basis every distribution. The strategy they use here is they use, deep in the money call options. Okay. So the deep in the money is actually a great strategy, especially in a market that you think where things could fall. Because what they're doing is they are buying the S&P 500 like a SPY, and they're selling calls on it at a lower price to take that spread, right? So that's the strategy for XPAY, and I like it. I owned XPAY for a lot of 2025. I think I sold it maybe in the fall. And go back here and I can kind of look and see, but yeah, I liked it when I held it. The reason I got rid of it, I was trying to simplify the portfolio a little bit. And let's see if I can find when I did sell it. I sold 200 shares of it in November, actually. So yeah, in the fall, sold out of it. What my goal was, what my thought was, I've got XDTE, which pays about 30%, right? About 30% annualized. And I've got SPYI, which pays about 12%. Okay. So my mind was, why not just own XDTE and then SPYI? But what my thought is, owning an XPAY or a SPYT, what I think would be good about them is that you kind of get that distribution right in the middle. And there wasn't a lot of NAV erosion, if any. And as a matter of fact, there was some growth. I owned SPYT and then I owned XPAY. So why don't we talk about SPYT, the other one? This is Defiance's target 20% as well. I'm gonna give you a little bit of stats on this one. They are, so as we talked about XPAY, their upside was uncapped. SPYT's upside is capped, okay? Because what it's doing is it's using 0 DTE credit call spreads, okay? So every single day on the SPY, it's basically just riding credit call spreads. You're going to get a little bit of capped upside, but the trade-off with that, when you get a credit call spread, you're going to have some downside protection, okay? So distributions are a mix of income and return of capital. So I think in the short term, SPYT might not necessarily be as tax friendly. Again, I'm not giving tax advice. Those are just my thoughts around it. But what I like about SPYT is that it will provide income, right? And prioritize some downside protection, right? At the same time. In my opinion, okay, and I've owned both of these, and for the most part, based on the various market conditions that I owned them in, I've never owned them in a market crash. I think I owned a SPYT through the tariff tantrum, Liberation Day, whatever that February to April period was of 2025. And it didn't do too terrible in that roughly 20 to 22% sell-off that we had over those couple months. So I was happy with both. Personally, right now, if I were to get back into one of these, I would buy SPYT, right? You've heard me say it. I think there's a severe market correction, market crash coming. So I wouldn't want to own both right now. I like Roundhill a lot. I'm a huge Roundhill fan, right? I've got a lot of Roundhill funds in Cashflow Life. I also like Defiance. I own quite a few Defiance ETFs as well. Again, there's pros and cons to all the managers, all the ETFs at the end of the day. But I think maybe getting another strategy, right, around the S&P 500, I think might make a lot of sense. To get 20% and then borrow at 4.5% in the margin, right? I think could be a decent strategy. So what I mean by that is currently in my margin, I'm borrowing 4.5%. If I can get that 20% from SPYT and then maybe hedge it with more YQQQ, which also pays about 20% typically, theoretically, you'd get no NAV erosion, right? So some of my thoughts, QQQT is another one we'll look at real quick, and there's no comparison to QQQT. Last I looked, Roundhill does not have, I guess they don't have the equivalent, if that makes sense. So let me refresh this. I'm not sure what's going on with Robinhood's site. Sometimes the weekends, they get a little sluggish. So this is Defiance's NASDAQ equivalent of SPYT, but just on the NASDAQ. Okay. They also seek to provide 20%. The Qs are generally more risky, but what I found is I think on a credit call spread to pull 20% out of the Qs, I don't think you give up as much NAV. And because you're already getting usually a higher premium from the puts and the calls, right, that you generally get from the NASDAQ versus the S&P 500. The S&P 500 is considered more stable, less volatile. So this is another one. What I was thinking about doing potentially was putting 10,000 into SPYT, 10,000 into QQQT, get those 20% there, and then putting another 10,000 or so into YQQQ just to hedge those positions, get some of that downside hedge. So again, just to generate more income for Cashflow Life, this is something I'm considering exploring here. I don't have to worry about any sort of wash sales, as the last time I sold these was back in November. So love to hear your thoughts and comments. Again, I just wanted to look at, XPAY versus SPYT. I think, again, they're both good. I think you shouldn't lose sleep over trying to figure out which one's going to be a better performer. Again, I would just pick SPYT solely for the fact that I think there is some better downside protection since it has that capped upside. But if we keep melting up here longer, yeah, XPAY will probably do a little bit better. So again, please like and subscribe. Hope you got something from today's video, and have a great day.